Hey, how you doing? And welcome back to another episode of The Rules of Investing, a podcast that gets inside the minds of leading investors, economists, and industry experts, brought to you by Livewire Markets. I'm Ali Selby, and in the last episode, my colleague Chris Conway spoke with Langdon Equity Partners Greg Dean to learn how he hunts for opportunities in the world of global small caps, why you need to do uncommon things if you want uncommon results, and why trying to time small caps is a big waste of time. This week, we're talking all things tech. Tech stocks had been off to the races over the last 18 months, with the NASDAQ 100 lifting nearly 70%. The last 2 months have been an entirely different story though, with investors briefly panicking, selling off the Magnificent Seven, and market commentators heralding a great rotation in the US. Then everything bounced back like nothing had even happened in the first place. It's a very volatile, confusing time, but that's exactly when investors should be taking advantage of mispriced opportunities. That said, not all tech companies are created equal, so to help you identify the cream of the crop, we're joined by tech specialist Dom Rizzo from T. Rowe Price. Dom runs T. Rowe Price's global technology equity strategy, and in this podcast you'll learn how to identify winning tech stocks across multiple market caps and subsectors, why the AI train is only just getting started, as well as some of the stocks Dom is backing today. If you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so that you don't miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. Not a Livewire subscriber yet? What are you doing? Just head on over to livewiremarkets.com. It's free, easy to register, and you'll get access to insights from leading investment minds across the world. Okay, let's get on with the show. Thank you so much for joining us today on The Rules of Investing, Dom. Really excited to talk all things tech and AI with you today.
I'm excited too. Thanks for having me, Ali.
Let's take a step back first. There's obviously been quite a lot of volatility in the sector and in the world over the last few weeks. How are you making sense of the volatility, particularly when it comes to tech?
Volatility is definitely one way to put it. We've had a couple interesting weeks in the technology markets. And, it really all goes back to that CPI print on July 11th. Like you said, that's when people started talking about the great rotation away from the Mag 7 into the S&P 400 at 93. Since then, we had a couple other interesting pieces of news came out. We heard about the Blackwell chip delay at NVIDIA. And when I take a step back, I kind of think about one of my favorite quotes from JP Morgan. Someone once asked him, what did he think the market was going to do? And he said, it will fluctuate. And so that's what happens with technology stocks. They fluctuate. And personally, I think this is a really healthy bull market correction. And so why do I say that? So first, bull market corrections are usually fairly short and fairly violent. So if we look at what's happened with NVIDIA, say, over the past month, from top to bottom, that stock corrected roughly 30% in roughly 30 days. That's a pretty short and violent correction. Second, they typically have to happen after really strong bull market runs, and valuations get a bit extended. And so if we look at the global technology universe, historically, that universe peaks when we get to 26 to 28 times earnings. If you look out 2 years, that number got up to that 26 times level. So we got kind of to that extended valuation range. Now, to put it in context, we're all the way back at 22 and a half now after this recent sell-off. So we're back to a much more normalized level. And then finally, this sell-off seems to be inflation-driven, rotation-driven, but not necessarily earnings-driven. And if we look at a lot of the earnings this quarter, they were very strong, actually, kind of across the board. And AI is still driving the bus, but there's many areas that I think are going to start coming back in the next couple months. And so that's why I kind of think this is a healthy bull market correction rather than the start of a new bear market or kind of the end of the technology trade.
There's some market commentators who argue that investors got ahead of themselves on AI. Why do you think the momentum can continue once again?
Yeah, I mean, that's the nature of technology investing, right? And look, I think AI has the potential to be the biggest productivity enhancing technology for the global economy since electricity. Okay. And if we take a second and we ask why that is, and I'll give a little analogy for everyone listening. What's happening with AI? So there's two things. One is the rise of parallel computing. These GPUs, the graphics processing units, are basically parallel processing machines. And the other is on the software side, the rise of these large language models. And to give you an analogy for parallel computing and what it is, if I asked a traditional serial computer, a CPU, a central processing unit from the likes of Intel, to read Charles Dickens' book, A Tale of Two Cities, and to identify every time Charles Dickens says the word "the" in the book, it would start on page 1 and it would read the whole book serially in order. It was the best of times. It was the worst of times. And it would count out all of the "thes." The GPU, on the other hand, from NVIDIA, will rip the book into 100 pages and find all of the "thes" in the book. So you can see parallel-based computing is a lot faster when we're dealing with big data issues. What we've done with these large language models is we've ripped up the entire internet and we've given all this data context, right? So we've ripped up the internet into billions of pieces, and then we can pull out different threads effectively. Now, what's so interesting about that is that it's not just great for chatbots. That's great for all sorts of different use cases. That's great for code writing. It's great for simulation. It's great for cybersecurity. You can apply this type of compute to all different areas of the economy. And that's how you get to that statement, I think it has the potential to be the biggest productivity enhancing technology since electricity. Now, with productivity enhancing technologies, usually come speculative bubbles, right? That's what happens. People get too excited. And so if you go study the railroads, right? The railroad boom in England, big speculative bubble associated with this incredible leap productivity enhancing technology. Kind of more recent ones, the rise of renewables, the rise of China. China was this incredible productivity enhancer for the global economy, right? And that resulted in speculative bubbles. And then most recently, of course, in the 90s with the internet, right? You actually saw the internet improve the productivity statistics, which is really hard. So look, I think inherently that's what will happen with AI. Whether we've done it, not, or yet, I think kind of remains to be seen actually. But if you look at the stocks, most of them have just grown with earnings growth. And so I'm not sure we're in this period of irrational exuberance of a bubble like we were in the late 90s, very early 2000s. It feels to me like we've had this incredible earnings growth, and most of the stocks have moved with the earnings growth that we've seen.
Yeah, when I first started my financial journalism career, I remember field producing a story about 3D printing. And at the time, 3D printing was super sexy. It was all the hype.
What year was that? I remember that.
It was in the late, probably 16, 17.
Yeah.
Anyway,
I covered a bunch of the laser companies at the time that did that. Yeah.
Yeah, there was all this excitement. There was all this hype. And I feel like we could be seeing that in artificial intelligence. There's definitely stocks on the ASX, for example, that say they use artificial intelligence and they've absolutely soared because of that. Are you seeing that in any of the companies that you cover?
Yeah, who are the AI imposters is what we call it internally. You have to find
exactly.
You have to find the real AI companies versus the imposters. Look, let's take a step back and take the poster child of AI, which is NVIDIA. We've owned NVIDIA and the strategy for a long time, and it's been a very large driver of the performance of our strategy. If we take a step back and think about where the earnings were in a stock like NVIDIA, in November of 2022, right? So right when ChatGPT was launched, roughly speaking, in November 2022, the January 26 earnings, so the calendar 2025 earnings for NVIDIA from the street were 62 cents. So the street thought that NVIDIA was going to earn 62 cents. That number today is $3.75. So we've gone from the street thinking that they were going to earn 62 cents in November 2022 before ChatGPT was launched to $3 and 75 cents, whatever the number is roughly today. Why is that? It's because we've seen an explosion in their data center revenue, and semiconductor stocks have very high incremental operating margins. And with that explosion of data center revenue, we've seen an explosion in earnings growth. Now, what's happening right now is NVIDIA is kind of eating all of the earnings growth in tech right now. Not as many companies are growing like that. I mean, I don't think we've ever seen a company grow like that in the past. So the question is, will there be others over time that benefit from this trend? And I think like a company like AMD has the potential to be a nice second source to NVIDIA. A lot of these chips are being manufactured at TSMC on top of machines from ASML. So there are other areas that really benefit from it. But I would be careful and really think about which companies truly benefit from AI and which ones are more the imposters, so to say.
Is there any risk that we don't use the technology as much as we are hoping, I guess? I mean, everyone thought 3D printing would change the world and hardly anyone uses it now. Is there a risk that people don't use AI to the extent that we're hoping they will?
There's always a risk, but I would say that we've already started to see it in some of the numbers. And I think there's a question, everyone wants to know what's the great next application driven by AI, right? What's the, Uber wouldn't be possible without 4G technology, right? If I had told you at the beginning of 4G, what we're all going to do is get into the back of strangers' Toyota Priuses whenever we need a ride, you would have thought I was crazy, right? We actually don't know what that AI native application is today, right? That remains to be seen. We do know that AI and parallel-based compute is meaningfully accelerating the businesses of the most profitable companies in history. So if we look at Meta, right, putting up an over 20% growth number on some very, very difficult comps, that's because of AI, right? That's because that they've done a really great job at the ad tools for their advertisers, but also placing those ads within everybody's feeds, right? If we look at Microsoft put up a 30% Azure growth number. That was 800 basis points driven by AI growth. So that means actually that the core Azure business was only grew meaningfully less, right? It grew in the low 20s. So you have to think about where is AI accelerating, and I think AI is actually going to meaningfully accelerate Apple's business, which is the most profitable business in history, which is the smartphone, and it's going to result in an upgrade cycle for the smartphone. So it's already starting to accelerate the businesses of the most profitable people in the world. The question I think everyone always asks me is, when is AI going to change my day-to-day life, right? And when am I going to wake up and have that perfect personal assistant that is actually an agent that can actually go do tasks for me? I think that's coming, but that will also take time. So in the short term, really, really beneficial to the most profitable companies in history. In the medium term, going to change our lives in meaningful ways, but I actually don't know which applications those are going to be yet.
So would you be taking advantage of the sell-offs in some of those Mag 7 companies?
Look, my not to just keep quoting great investors that came before, but Peter Lynch has a wonderful quote about, when do you buy stocks? And he always says that more harm is done waiting for the correction than actually in the correction itself, right? And when I think about these Mag 7 stocks, or even the broader technology universe, let's say, look, the expanded technology universe grows earnings much faster than the rest of the market. If we take the Mag 7 versus the S&P 500, the Mag 7 over time historically grow earnings anywhere from 50% to 100% faster than the rest of the market. Usually closer to that 100% range. If we look at the premium that the Mag 7 trades at, though, it only trades at a 50% premium to the rest of the market. So the S&P Mag 493 versus those Mag 7. And so actually on a PE to growth rate adjusted basis, the Mag 7 is cheaper than the rest of the market for the earnings growth that you get. And so when I think about technology investing in general, it's a really healthy place to be. You have to think about your own risk tolerances, right? Everyone has different risk tolerances, but in general, it's a very healthy pond to be fishing at.
Okay, we're going to take a quick break to hear from our partners, and then we'll be right back with Dom Rizzo from T. Rowe Price. And we're back with Dom Rizzo from T. Rowe Price. Okay, Dom, I want to talk a little bit about the macro. Investors are now worried about a recession in the US. The market's pricing in 150 bips of rate cuts over the next 2 years. What are you actually seeing on the ground? Are there any signs of pain that you're actually seeing?
This is probably one of the best parts about being at T. Rowe, right? We get to meet with all of these companies every quarter after their earnings. And, even though I run our global technology strategy, I'll sit in different meetings in order to hear, how the consumer's doing or how different parts of the industrial economy are doing. And look, in general, there's been a slight slowdown in the global economy, it feels like, particularly at the low end of the consumer, right? We saw that in the numbers from the likes of Visa and MasterCard. And we're seeing that in areas of the consumer economy as well, where people are not seeing the value to price ratio match up and then inherently using services less. What's been really interesting to me is on-demand services like an Uber or DoorDash have been very strong through that environment. And I think that talks a lot about the value that people place on convenience, actually, in the global economy and what that means going forward and how much people value convenience. But in general, I think we're in a slightly slower environment. And I think the general trend for the rate of change for interest rates is lower. Now, the question is, are we going into a hard landing or not? Because if we go into a hard landing, interest rates going down is a bad thing for risk assets, right? If we're going into a softer landing where it's slightly slower growth, but the global economy is generally fine, lower interest rates are good for risk assets, right? It brings down your weighted average cost of capital, investments go up, and capital expenditures go up. And then usually that means that equity markets perform well. I'm in the moment more in the camp that we're going into a softer landing rather than a harder landing. But I think we need to be vigilant and stay on our toes and keep getting the next data points.
Okay, let's go back to basics. How do you identify winning tech stocks?
Yeah, having a framework, it's the most important thing in investing. And you really have to have an investment framework, I think, that matches your personality. So one of my favorite investment frameworks I've ever heard was someone said, I'm a pretty boring person and I like boring stocks. And what they bought, stocks like consumer staple stocks, they bought utilities, and they did great over time. I like innovation and I like change, right? That's my personal thing. And so how do I navigate innovating in innovative markets responsibly is what we always try to do. And there's 4 things I look for. So the first is what I call linchpin technologies. So a linchpin in a car, if the linchpin falls out, the wheel will fall off the axle. These are the most mission critical technologies for the success of their customers, or they make their users' lives dramatically better. The quintessential one right now is NVIDIA, but there's a plethora of them within tech. The second, they have to be innovating in secular growth markets. So I tell our team all the time, we don't want to buy companies that sell lifeboats to sinking ships, right? We want to be surfing in healthy markets. And so we want to be taking share in those fast growing end markets. The third, and the thing that's probably most important in short-term changes in the strategy, is we look for improving fundamentals. So that usually comes in the form of 3 things: either revenue that's accelerating, so growing faster than you used to, operating margins that are expanding, or free cash flow conversion that's improving. And finally, you want a reasonable valuation. Now, finding a perfect stock is impossible. It's very rare that something fits all 4 parts of those framework perfectly. So you're always making choices. Actually, one of the few times that a stock actually did fit all 4 parts of the framework perfectly was NVIDIA in December of 2022. They were about to have improving fundamentals. Their revenue growth was going to accelerate. Their operating margins were going to expand. Their free cash flow conversion was going to improve. Their valuation was really reasonable. They provided this mission critical technology, and they were serving this market that's, the AI chip market's going from $45 billion in 2023 to $400 billion by 2027. So it's one of the few stocks that actually fit the framework perfectly at the time. But you're always making choices. And so you have to have a framework. And those are the 4 things that I look for when I'm looking at tech stocks.
How do you think about risk? You're obviously investing in a more risky area of the market. You're not investing in boring stocks, as you mentioned before. How do you limit any losses and portfolio volatility?
Our goal is to create a true all-weather technology strategy for our clients, right? That's what I try to deliver. And what does that mean? Does that mean we're not going to go down in down markets? No, of course we're going to go down in down markets. But it's about trying to blunt those losses to the best of our abilities. And then in up markets, try to capture the upside, right? And provide that technology exposure that many people are looking for, given the fast growing earnings growth in tech and what I think are reasonable valuations. And the way you do that is really through construction of the strategy, right? You have to have a balance of the different types of names in the strategy. And what I love about my strategy, it's really a go anywhere strategy. We can buy small caps, we can buy mid caps, we can buy large caps, we can buy mega caps. We can buy in US, Europe, Asia, developing markets, emerging markets. We can do hardware, software, internet, and payments. And with that, you can put together a strategy of idiosyncratic names that should hopefully act different at different times. And so you can have more ballasty names in the strategy, a name like Apple or Microsoft, which provide a more durable growth profile, maybe a little bit of a slower growth profile than some of our fast growing names like Shopify or Datadog or Confluent, which provide a little bit more growth, but higher valuations and a bit more risk. So it's about finding that balance. And the best is when you can get high growth at relatively reasonable valuations, right? That's the best thing you can find. But the market's smart, and they can often make you pay up for those type of names. But it's about putting together a bunch of idiosyncratic names that hopefully move together differently and can try to blunt that downside a bit and then try to capture the upside, which is obviously very hard to do.
I feel like everyone has a shopping list or a wish list of stocks that they would love to own at a cheaper price. Since we're seeing this volatility in markets right now, I'd love to know yours. What tech stocks would you love to own at a cheaper price?
Yeah, I found it's often easier to just already have some exposure to the names that you really like in your strategy and then try to take them up in periods of volatility, right? And why is that? It's because, really wonderful companies often surprise to the upside. One name that's constantly surprised to the upside for me is a name like Shopify. So every time I've looked at Shopify, since, I've started looking at the company, I've always viewed it as expensive. But there's a couple really interesting things with Shopify. So number one, they provide this incredible linchpin service for their customers, whether it's small businesses or now increasingly large enterprises. They really rely on Shopify for global e-commerce capability and payments capability. Second, you have a really world-class management team in Toby and Harley and Jeff, and the entire team there is just best in class in terms of their execution. They're innovating this incredible secular growth market, which is e-commerce, and they're continuously taking share. And then there are different periods where they'll have improving fundamentals and hopefully reasonable enough valuations. So when I think about these downturns and which names sit on the shopping list, so to speak, names like Shopify, come to mind in terms of companies that can fit the framework really well at given times. But often with the most special stocks, you end up having to pay up for those premiums anyway, right? The market's relatively efficient in identifying the true winners over time. And so the question is, how do you size appropriately in a strategy in order to make sure that the risk profile doesn't get too far off?
Let's stick with that then. Which stocks do you think it's worth paying up for right now?
It's a really good question. When I look at the strategy as a whole, I kind of have a few different themes that I think are really important. So number one is digital semis and the rise of AI, right? So digital semiconductors are the lifeblood of the global economy, and digital semiconductors really are the brains and intelligence behind all this incredible improvements that we're seeing. What we've seen in digital semis recently has been kind of a tale of two cities. Really, really strong growth in AI, really weak growth in PCs, smartphones, traditional enterprise server, telecoms, all the other traditional areas of digital semis. Next year, if we look into next year, I think most of AI will see decelerating growth, so growing slower than last year, but still very strong. And the rest of the areas will see improving fundamentals. So names that fall into that bucket that I really like are like names like AMD and Taiwan Semi that have that type of exposure. They have both the AI benefit, but then they also have the traditional exposures. In terms of some more expensive software names that are very attractive over the very long term, but you are playing with heavier valuations, the name that always comes to mind for me is ServiceNow. So ServiceNow, they're the leader in IT service management, increasingly IT operations management, and basically their ticketing tool, sounds simple, has a million different applications within the enterprise, whether it's HR, financial services, whatever it may be. You can use their ticketing tool across the entire application landscape, and they're increasingly putting AI into that ticketing tool. So they're becoming what the CEO, Bill McDermott, likes to call the platform of platforms, right? Many different apps are being built on top of them. So you can always find great expensive stocks and fast-growing software. You can always find reasonably priced stocks in areas like digital semis, and then using sell-offs to balance the strategy how you want it is kind of the way I always think about it.
We talked a lot about semiconductor stocks today. The portfolio has a 43% exposure to them. I don't think I've ever seen a portfolio with that much exposure to semiconductor stocks. Are you worried at all about concentration?
Of course. So I think about it a lot. So the first thing that I think is really important is not all semis are the same. They all have different cycles, right? So we have analog semis, names like Texas Instruments, ST Micro, Infineon, Analog Devices. These companies sell into the auto and industrial and markets, right? And auto and industrial end markets have different cycles than the smartphone end market or the PC end market or the AI supercomputer market, right? Those are very different end markets. So analog is different than digital. And within digital, you have more commodity chips like memory chips from the likes of Micron or Samsung or Hynix. And you have really differentiated chips, these GPUs from NVIDIA or AMD. And then you have semi-capital equipment, which are the companies that make the tools that the chips are made on. And then you have foundries like TSMC, where many of these chips are made. So a whole different ecosystem, all of which has different cycles at different times. I get asked the question a lot internally, are semiconductors no longer cyclical? And I think semiconductors will no longer be cyclical when humans are no longer fallible, right? Because it's inherently a human-based purchasing process. You can't get enough chips, so you double order the chips. And if you double order the chips, you make too many of them. And then all of a sudden there's a global macro correction, and then you cancel your orders. And then all of a sudden we see revenue corrections. So I think it's about finding the right cycles at any given point in the semiconductor cycle. And the AI semiconductor cycle is probably the most powerful cycle that I've ever seen. We talked about the numbers before, but I think the AI chip market is going from $45 billion in 2023 to $400 billion by 2027. So over a 70% CAGR. NVIDIA remains the leader. I think AMD has the potential to be a very strong second source. And there's many players involved in that entire ecosystem who will benefit. Now, there's two things about the AI cycle which I think are important to remember. One, we're finally at that period of decelerating growth for NVIDIA. NVIDIA can't grow 50%, 100%, 150%, 250%, and faster forever. At some point, they need to come down to more reasonable growth rates, whatever that numbers end up being. And then two, the AI CapEx cycle will also decelerate. So this year, we're going to see 50, 60% CapEx growth out of the likes of the hyperscalers, Amazon, Microsoft, Meta, Google, all are growing their CapEx budgets very quickly. That needs to slow down to more normalized growth rates too, 25 to 30% potentially next year, and then potentially slower after that. And so the question is, can we navigate that cycle responsibly? And that's where we come back to the framework, Ali. That's when we try to find those linchpin technologies innovating in secular growth markets with the improving fundamentals of reasonable valuations to help us navigate that environment responsibly.
Yeah, if NVIDIA's growth is slowing in the future, are you still
when,
as bullish
right?
on
Eventually,
it?
mathematically, it has to be when, not if.
So when NVIDIA's growth slows in the future, would you still be as bullish on the stock?
Well, we're kind of, the hard part is we're kind of there now, right? We're at that decelerating growth point now. The question is, can they continue to execute the way, they've had near flawless execution up until this point. Can you keep executing at this level in a decelerating growth environment? It gets harder. It's very hard to bet against Jensen and his team. His team have done a wonderful job. And I think this kind of lends to the point that, yeah, it's a harder setup today than it was, say, 6 months ago or 12 months ago. But that's why you have all 4 points of the framework too. And you need to measure the decelerating growth environment relative to the valuation, relative to their linchpin status, and relative to the market opportunity that they're attacking.
Let's talk a little bit about cash. You're hardly holding any cash right now. How do you take advantage of sell-offs like we're seeing right now, volatility? Do you trim your winners or cut your losers? How do you actually create that cash to put that money to work?
It's a really insightful question. So not a lot of people ask me about my cash balance and why I run it so low. So if you go and you study the difference between active management and passive management, one of the reasons active has struggled in the past, and there are many potential reasons for it, and if you look at the best active managers, they can outperform, but one of the reasons actually is cash balance, right? So cash balance is a drag in up markets. And I think timing the market is very, very hard. And so that's why I run with the cash balance so low in the strategy, because over time, cash has been a drag on strategy, on performance, right? That's just the nature of what cash is. Now, if you could time the market perfectly, it's an amazing thing, but I've yet to meet someone who can actually do that. All that being said, you have to create cash in downturns, right? Because you have to be able to take advantage of those downturns. And downturns are actually a really important part of strategy construction. And why is that? Is because that's when you really should cut your losers, in my opinion. That's the period of time where you really study all the names in your strategy, and you look to take out names that don't fit your framework. And the reality is, as a portfolio manager, you kind of know, right? You know which names in your strategy don't fit your framework currently, and you've been holding on to for the wrong reasons, actually. And so downturns often create that necessary opportunity to pivot into names that you think are better. And sometimes that means selling stocks low to buy stocks that are even lower in your mind, right? And that's actually very hard psychologically to do. But in general, I think over time, cash is a drag on most strategies. And in downturns, you can use those downturns to really clean up your strategy.
So double down on your winners and cut your losers as early as possible.
Depending on the situation and depending if they fit your framework, right, Ali? Right? It's everything is it depends in investing. I have plenty of both. In general, I find that the stocks that I know I need to move on from are the stocks that no longer fit the framework that haven't worked. And the stocks that I would want to stay with are the stocks that do fit the framework that have been working. But everyone's different too.
Okay, we've come to the final 3 questions of the podcast. They're meant to be a little bit of fun, a little bit of a thought experiment. What is one thing you think investors are currently getting wrong about markets?
It almost sounds silly to say, but I think the size of AI, what it's really going to do to the global economy, what this type of productivity enhancing technology means for the global economy. I think it's bigger than a lot of people think. And the magnitude of the change and the duration of the change is longer than people think.
Okay. Do you have a story of a big win or a big loss from your investing career? It can be super early on. Maybe it was last year. Maybe it was last week. I don't know.
Yeah.
What did you learn from that? Big win or big loss?
I have too many to count.
Don't we all?
If we go through losers, names that I've in the past really struggled with. I used to cover small and mid cap laser companies, which were really an incredible place to cut your teeth because it was cyclical and really high tech, right? Like lasers are some of the hardest things to do up there. It's up there with semiconductors, and there was this major change happening. I don't know if you remember in like the 16-17 period, we were transitioning from LEDs to organic LEDs on smartphones. And it's why with the iPhone 10, the phone got a lot bigger, the screen size got a lot brighter. And you had to build out these massive manufacturing plants with a lot of these lasers from this one company called Coherent in the US. And what I learned with that is a couple different things. One, you can be very excited about a cycle, but you have to really think about its duration and its magnitude. So to compare the organic LED cycle versus the AI cycle, the organic LED cycle was one time in nature. So you built it out once and then you really didn't have to do it again. The AI cycle, on the other hand, I think builds on itself over time. You put these GPUs in the ground, you come up with new applications that actually drive demand for further new GPUs because they figure out new applications or figure out net new things. So it builds on itself. It's reflexive inherently, and reflexive cycles go both up and down, right? So had to learn out magnitude of cycles versus and duration of cycles. It taught me how to invest in capital equipment. So I really was excited about the math of what their service revenue stream could be, but often in capital equipment, what really matters is the ups and downs of the cycle. And so I think that's why I put so much emphasis on the improving fundamentals portion of a thesis, because what really matters are when are fundamentals inflecting positively and when are they starting to inflect negatively. So that was a really humbling experience for me, and I learned a lot from that whole experience. On the other hand, we've had winners too. You know, two names that have been great long-term investments for T. Rowe are the EDA companies, the electronic design automation companies in the US, Synopsys and Cadence. And if you've looked, we've been long-term holders for a very long time on those names. And that's where I kind of came up with the linchpin portion of the framework. These companies are absolutely mission critical to the success of their customers. They design the software that all of the semiconductors in the world are designed on today. So they're really mission critical. And so that was the layering in of that linchpin portion of the strategy. And those names have done very well over time. So the name that was tougher taught me about the importance of improving fundamentals. The names that were a bit better taught me about the importance of the linchpin technologies. So it doesn't feel good when you're learning from the losers in the moment. It feels a lot easier to learn from your winners. It's like that. It's funny, but you get your best lessons from your losses. You get your
100%. Oh my God, I definitely agree that I've learned way more from the stocks that have absolutely tanked than those that have done all right or well. Okay, last question for today. If the market was to close for the next 5 years and you could only hold one stock, what would it be and why?
So the way I thought about this is, in a way, on my framework, it's kind of asking which company is the ultimate linchpin, right? Because markets move up and down, but linchpin technologies, they're able to continuing to innovate and kind of regardless. And when I look through the global technology universe, I think the ultimate linchpin technology may be ASML in the Netherlands. And so ASML is the worldwide leader in this technology called lithography. Lithography is one of the four most important steps in semiconductor manufacturing. And so there's four main steps, not to get too technical, but there's lithography, where you print the picture of what you want the chip to be on the wafer. There's deposition, where you deposit a bunch of materials on. There's etch, where you cut around those materials with the picture you want it to be. And there's metrology, where you measure it, and you make sure that you didn't mess it up, right? Those are the four steps in making a chip. You do that 50 to 100 times and you have a chip, right? That's how chips are made. ASML's tools make the picture on the wafer thinner, which means we can get to smaller and smaller node sizes, which means that we can fit more transistors in a given area, which means that we can keep making better and better chips, right? That's the way to think about what they do. And for what they do, they provide so much value that the current tools cost north of 200 million euros, and the next generation of tools cost north of 300 million euros. And these things are massive. I mean, I've sat underneath them in their manufacturing facility before. They take, they're the size of 2 double-decker buses. They take 3 different 747s to ship one machine from the Netherlands to the manufacturing facilities in Asia or in the US. I mean, they are the most incredible. They are truly, they could have won a Nobel Prize in physics for this technology. And really, without shrink, so much of our semiconductor progress, and thus so much of our technological progress as a society, would slow down. And they're the only company in the world that has this incredible extreme ultraviolet lithography technology, and their next generation, the high NA technology, and then the following generation, the hyper NA technology. And so in many ways, I kind of think about them as the ultimate linchpin technology.
Okay, well, I absolutely love this conversation today, Dom. Thank you so much for your time and sharing all your ideas and insights with our audience. I really, really appreciate it. Thank you again.
Thanks, Ali. It's fun. Hopefully we can do it again soon.